Just imagine you wake up one day and you see that your grocery list bucket has gone from rupees 1000 to rupees 5000. What will be your reaction? You go to the gas station, you go to the clothing store, you go everywhere and the prices you see have been shoot up. What's the reason? The reason is inflation. What is the cause of inflation? How does it impact us? And the most important thing, how can we control the inflation? Let's study everything in today's video. Inflation generally refers to the sustained increase in the general price levels of the various goods and services over time. Simply put, if your money buys you less as compared to before, you are experiencing inflation. In India, we generally measure inflation through two indices, CPI and WPI. CPI stands for Consumer Price Index. WPI stands for Wholesale Price Index. Let's talk about the real reasons of inflation in India. Reason number one, fuel prices. India imports 80% of its fuel from other nations. So when the fuel prices shoots up due to wars, due to sanctions, OPEC cuts, it directly affects India in transportation costs. So the prices of vegetables till delivery charges, everything goes up. Reason number two, food inflation. Unseasonal rains, crop failures, and also the shortages in supply due to various conditions, which leads to double up the prices within days. Reason number three, global supply disruptions. Events like COVID-19 pandemic, Russia-Ukraine war have also disrupted the supply chains of various raw materials like metals, fertilizers, which has led to the increase in prices of these products. Reason number four, post-COVID demand surge. Post-COVID, the demand bounced back rapidly, but supply could not keep up. This imbalance led to the prices pushed up higher. Reason number five, currency depreciation. When the rupee weakens against the dollar, the imports become costlier. This feeds inflation. Inflation is not just a macroeconomic term. It hits real people and real households. Your purchasing power falls and also your same money buys you less of the amount of the goods. Retired individuals and also fixed income households suffer the most as their income does not grow along with the rate of inflation. Investors become cautious, businesses does not grow that rapidly, and so the overall economic growth suffers and takes a backside. And who gets the blow first? The poor, because inflation is uneven. The poor spends maximum of their income on consumption of basic needs and foods. So they feel the blow firsthand. In India, the responsibility to control the inflation lies with Reserve Bank of India. RBI controls the inflation through its monetary policies. So let's break down the tools and see how the RBI controls the inflation through various rates and cuts. First tool is the repo rate. It is the rate at which RBI lends to commercial banks. If the repo rate increases, then the borrowing becomes expensive, and so it leads to lowering of demand and hence lessen the consumption. Therefore, the inflation cools down. Second tools are the cash reserve ratio and the statutory liquidity ratio. These ratios determine how much money commercial banks can lend in market. So therefore, when RBI increases these ratios, so the commercial banks can lend less in the market and therefore decreasing the money in circulation in the market, and hence when the money circulation is decreased in the market, at that time inflation also cools down a bit. Third comes the open market operations, where the RBI sells the government securities in the market to absorb the excess money in circulation and hence reducing the inflation. Monetary Policy Committee MPC also takes the fourth position in our discussion, because this committee meets every once in 2 to 3 months to discuss the interest rate paths and their main goal is to stabilize the inflation within a rate of 2 to 4% with a band of plus minus 2%. RBI walks upon a tight rope. If it acts too fast, it may hurt the economic growth of our country, and if it acts too slow, then the inflation can become wild. Is inflation always a bad thing for our economy? No, a moderate level of inflation can indicate a developing economy. RBI has prescribed 2 to 4% of inflation rate to be stable with a tolerance band of plus minus 2%. But the problem sets in when the inflation becomes uncontrolled, persistent, and when the inflation rate is higher than the growth in the wage rate. A higher inflation rate can always indicate that it destroys the savings of individuals, it leads to decrease in investments, and also increases the situations of uncertainty. RBI doesn't aim for zero inflation. It always aims for a stable inflation rate. Moreover, inflation is like cholesterol. Too much can be fatal, but a little is always necessary. RBI is always taking steps and always devising policies to control inflation. On our part, we can do our own financial planning, savings, investment, etc. in so much unpredictable globalized world. So, if you like my video, then please give a thumbs up, subscribe to my channel, and also comment below the thoughts.